Quick question for you. If you had a chance to invest in a high yield income ETF or a dividend growth focused ETF, which one will you pick? Dividend growth investors, bonjour, my name is Mike Héroux and I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. I've received these questions about JP Morgan Premium Equity ETF, JEPI versus Charles Schwab US Dividend CSHD. And a lot of investors are just like, yeah, Mike, would you make it comparable on this one? So we're in for a treat today. We're going to talk about their strategy, a quick overview, sector and stock diversification, their performance, and also we're going to have a summary of which one could be a good thing for you as an investor. And at the end of this video, I'm gonna tell you why I do not have them in my portfolio, and I have a very good reason. So for the sake of the video, to make it simple, we're gonna call it JP Morgan ETF versus Schwab ETF. So it's gonna avoid me to say JEPI all the time and CSHD, which eventually I'm gonna mix up the letters anyways, right? Okay, so JP Morgan ETF strategy is all about generating income. So the company, the ETF is investing in stocks, but they're writing covered calls. So it's a mix of companies, dividend, plus options to generate such a high yield. When you look at this graph, which is incredible, is the yield, right? So it's really generating the highest possible level of income. We're talking about double digit, and obviously this percentage will fluctuate over time, but most of the time it will be above 10% yield. So you invest $100,000, you make 10 grand per year in income. So it sounds like your retirement dreams come true, right? On the other side, you have Schwab ETF that is really focused on tracking the Dow index, the Dow 100. So it's a more like dividend grower focused company ETF that will enable you to track the Dow 100 index with a low cost and tax optimization. So overall, two very popular ETF. On one side, you have JP Morgan that offers a lot of high yield, but also comes with a little bit more expense in terms of fees. So we're talking about fees of 0.35 versus Schwab at 0.06. In terms of yield, we're talking about double digit yield versus roughly like 3.5 to 4% for the Schwab index. And in terms of assets under management, one has 22 billion and the other one has 44 billion. So Schwab is definitely larger, but at the same time, it has been around for a longer time as well. As the JP Morgan ETF has been created recently. We're going to see that in the performance table as well. So we have a short-term terms for performance comparison. Once I've looked at the strategy and the overview in terms of fees and in terms of yield, the second thing I like to do when I look at an ETF is to look at their diversification. So I want to know a little bit more. So it's one thing to know about the strategy, but then I want to know how this ETF is invested, right? So in terms of sector and also in terms of stock allocation. So here's the sector allocation for JP Morgan ETF. As you can see, main sector is industrial, then you have healthcare, financials, and consumer staples, which is the bulk of those sectors. Overall, I like when an ETF is well diversified like this, because then if there's any problem at one point with one specific sector, let's say regional banks, then you are not too exposed to that sector and the ETF should still do well. When you look at Schwab's, it's a little bit different, and it actually looks a lot like more my own stock diversification, my own sector diversification. So for Schwab, you have a larger concentration on information technology and financial sector, which I share with Schwab. My third largest sector is consumer discretionary. This one is consumer staples. I don't invest too much in healthcare. But overall, great diversification, but you can see it's a little bit more focused on a few sectors. So if you look at the top four, we're like what, like 20, 40, 50, 60, a little bit more than like almost 65 across four sectors, which is definitely a strong concentration. So when you have that, you're all either going to do very well or not that great, depending on how those key sectors do. Now let's go into one more layer of diversification and let's take a look at how they invest in terms of stocks. JP Morgan, top 10 holdings, and this is like one thing that I really like when I look at ETF is their top holdings. I really want to know which stock will move the needle in their performance. In this case, not much, but again, keep in mind, they are writing options on those stocks, and this is how they generate the bulk of their money. So the holdings per se, yes, it's important, but at the same time, it's a lot more important for them, for their ability to generate income from those options rather than the stock itself. So you can see 1.4, 1.5% of each of the top 10, not gonna move the needle anyway. So if they go skyrocket, it's not gonna change anything. But again, it's really about their ability to write options on those holdings. When you look at Schwab, it's completely different. Then you have companies between 4 and 5% of weight for each of the top 10 holdings. The top 10 is weighting 40% of the total portfolio. So if you look at the top 10, if you like all of those companies, you have a pretty good ideas of what is going to be the return. When I look at it, well, I have a few classics that I really like Broadcom, Coca-Cola, Lockheed Martin, Pepsi, Home Depot. Not too convinced about Verizon Wireless. The other one that I don't like is definitely IBM. I'm not a big fan of this one. Cisco, I think you can find better tech stocks than Cisco, like Microsoft or Apple. I would have expected those two to be there, but obviously they're following an index, so they're kind of limited. This is one thing I don't really like about ETF is when they focus on an index, it's really hard to get out of that and then add some more thinking and then play around with your holdings because you're tracking something. So you're either in or you're either out. So now we know that JP Morgan ETF is all about income. The other one is all about pretty much dividend growth by tracking the Dow index, the Dow 100, sorry. How they have been performing throughout the crisis of the pandemic. I wish I had more time to see what really happened, but JP Morgan ETF was created in 2020, so we're pretty much stuck with that. Here's, you see total return for both ETF, and then when we say total return, we say capital gain plus reinvestment of the dividend. So it is really important because a lot of investors are asking me, yeah, but you're comparing apple to oranges because you don't see the double-digit income that is being reinvested. And then when you have to think about something, if you reinvest your income from JP Morgan Equity Premium Income ETF, you reinvest in it, well then you're not creating any source of income whatsoever because you're just reinvesting that money, right? So you either invest in this one to generate income and then you take that money and you run, or you reinvest and then you don't generate income, so the yield doesn't really matter. And one more reason to say that the yield doesn't matter, well, if you look at both after roughly 3 years of performance, you have Schwab that is generating 53% total return versus JP Morgan at 38%. So there's already a big gap. You can see that there's a lot more fluctuation with Schwab versus JP Morgan. That is gonna make sense because JP Morgan, they're writing options. If they're doing always the same strategy, chances are they're gonna smoother a little bit more their returns as versus that Schwab that is just invested in stocks. And then, well, we all know stocks and volatility, they come hand to hand. So performance is one thing, but then you might want to have a complete table of what's going on here. So I've made that chart to help you make a choice between one and the other, because when you look into each ETF, they're definitely not the same, and it's really important to understand in what you invest to make a good decision. So on one side, you have JP Morgan ETF, which is all about options, generate income, have lower volatility. The expenses are higher, makes sense because you have to pay people to write those options. The yield will be double digit between 10 and 11, which is pretty cool. Assets under management, pretty solid as well. $22 billion invested in that ETF, which is a lot of money, so you don't have to worry too much about that part. On the other side, you have Schwab ETF that tracks the Dow 100, little fees, little dividend, but you can expect more growth coming from this one. So 3 to 4%. So if you're looking for income, it's still not a bad choice, but it's definitely not something that you're gonna make $10,000 for each 100 grand that you invest. And finally, assets under management. It's double the size of JP Morgan, but it has been around for a longer time. When you look at performance, definitely Schwab ETF has been very solid. And in fact, when you think about it, it is probably a very good solution for someone who would like to have exposure to the US market that focuses on dividend payers, but do not wish or do not have the knowledge to research and invest in individual stocks. From my perspective, I would definitely pick Schwab over JP Morgan. I think over time that difference in performance will be even wider, which is totally making sense. Honestly, I'm not a big fan of covered call ETF in one way or another. I've seen that so many times where you actually sacrifice a lot of total return just to get a higher income. So from a math perspective, you work all your life, you build $1 million, you invest that, and then you're making 100 grand a year in distribution from JP Morgan ETF. That's cool. One thing you have to consider though is total return will be likely higher if you choose another option. And the second thing is, if that 10% doesn't increase, if that 100 grand doesn't increase, it's great for year 1 of your retirement, but on year 25 or year 35, because when you think about retiring at 60 or 65, you have up until 85, 90, maybe 95 years old to pass away. Well, then that 100 grand is not gonna worth more if you consider inflation for 20, 25 years. So you have to consider that as well, as opposed to Schwab, which focus on total performance. So finally, why do I not care about investing in Schwab or JP Morgan ETF? Well, here's the short answer. So since 2017, I cannot add money into my Lira account. I mean, it's a pension plan that I received from my former employer. I started investing it at the end of 2017. So to be fair, I started a comparison on September 1st, but really I fully invested that money after the first 3 months. So I should have even picked up at the beginning of 2018, because at the beginning that money was just in cash. But even then, I decided to be fair and just take it from September 1st all the way up to March. Sorry, I'm just going to look at March 27th. Just the date that I was recording this video. So my portfolio shows a total return of 95% on that date versus 85% for Schwab. Not a big difference, but still a difference. So if you consider that actually I given Schwab a head start, because in September was actually a very good month. September, October were good months in 2017 to invest. So they benefited from that head start, and yet I would still be able to beat the ETF on one part. The other part is half of my portfolio is in the Canadian market, which is underperforming the US market most of the time, and in this specific period of time, it happens as well. The third thing is, when I look at the top 10 holdings of Schwab, I would never invest in IBM. I think there's a lot of better options instead of investing in Cisco or investing in Verizon Wireless. So there's only like 14, 15% of their portfolio that I do not agree with. And obviously, keep in mind, I love looking into financial earnings. I like to manage my portfolio, dig a little bit deeper. So it's like some kind of like work for me, but it's also a hobby. So I don't mind spending those times to manage my portfolio. For someone who is looking for I don't want to do anything solution and still get a good return, definitely Schwab is very interesting. From someone who doesn't even want to calculate anything and just wants to focus on an income, JP Morgan could be interesting, but I would still track this one a little bit carefully, because I would like to make sure that the distribution increase year over year to at least match inflation. All right, so that's enough for today. Let me know in the comment if you prefer Schwab or JP Morgan, or if you're in ETF investors altogether. Let me know if there's anything that you would like me to do in the next videos. I love to have like inspiration and question from you guys. I think this was a great idea to compare both, even though they're completely different ETF. They're both very popular and they both serve a good part of the investors world. All right, so let me know in the comments, give me a thumbs up, subscribe to the channel, and don't forget to stay invested.